The global economy in 2026 is not collapsing, but it's also not booming. Instead, we're entering a very different phase, one that feels quieter on the surface, but far more important underneath. After years of volatility, uncertainty, and aggressive policy changes, the world is now shifting into what can best be described as a period of stabilization and transition. A transition not just in markets, but in how the entire financial system operates. And if you look closely, you'll start to notice something interesting. Growth hasn't disappeared, it's just changed its character. Instead of explosive expansion, we're seeing something more controlled, more resilient, more deliberate. Global growth is expected to hover around the high 2% range. That might not sound impressive, but in the current environment, it tells a very specific story. It tells us that the system is holding together, not perfectly, but well enough to move forward. The United States continues to lead among developed economies, with growth supported by fiscal adjustments and a slightly more relaxed monetary stance. The U.S. economy has managed to avoid a hard downturn. Consumers are still spending, businesses are still investing, but the pace is measured, cautious, and increasingly dependent on efficiency rather than expansion. At the same time, emerging markets, especially in Asia, are playing a much more significant role. India, in particular, stands out. With strong domestic demand, digital infrastructure, and a rapidly expanding middle class, it continues to grow at a pace that outperforms most major economies. This is not just about numbers, it's about momentum. Meanwhile, China is undergoing its own transformation. No longer chasing the high growth model of the past, it is now focusing on stability, exports, and technological advancement. Growth remains steady, but more balanced, more strategic. And this shift matters because it reflects a broader change in the global economy, a move away from rapid expansion towards sustainable positioning. But growth is only one part of the story. To understand what's really happening, we need to look at inflation, because over the past few years, inflation has been one of the most powerful forces shaping economic decisions around the world. Now, for the first time in a while, we're seeing it begin to cool, not disappear, but stabilize. Global inflation levels are gradually moving closer to central bank targets. And this is where things get interesting, because when inflation begins to ease, central banks gain flexibility. And that brings us to interest rates. After a long period of tightening, we are now entering a phase where rate cuts are slowly being introduced. Not aggressively, not suddenly, but carefully. Measured adjustments designed to support growth without reigniting inflation. This is what economists often refer to as a soft landing. And while it's not perfect,
It's far better than the alternative. Borrowing costs are beginning to ease. Liquidity conditions are slowly improving. And confidence, while still cautious, is starting to return. But here's the part most people overlook. This is not just a normal economic cycle. This is happening at the same time as a structural shift in how financial systems operate. Because behind all of this, a new layer of infrastructure is being built. Digital, programmable, and increasingly integrated into the global economy. For years, traditional finance and digital assets existed in separate worlds. One was regulated, institutional, and slow-moving. The other was experimental, volatile, and fast. But that separation is starting to break down. Regulation is becoming clearer. Frameworks are being established, and large institutions are no longer watching from the sidelines. They are participating. Carefully, strategically, but actively. Asset managers, banks, and financial firms are beginning to explore how digital assets can fit into their existing systems, not as speculation, but as infrastructure. And one of the most important concepts emerging from this shift is tokenization. The idea that real-world assets, bonds, real estate, even funds, can be represented digitally, traded more efficiently, settled instantly, and accessed globally. This is not just innovation, it's transformation. Because once assets become digital, they become programmable. And once they become programmable, entire systems can be redesigned. Faster, more transparent, more efficient. At the same time, artificial intelligence is accelerating this transformation. What started as excitement is now turning into implementation. Companies are no longer asking if they should use AI, they are asking how to use it effectively, to reduce costs, to increase productivity, to make better decisions. And the results are starting to show. Operations are becoming leaner, processes are becoming smarter, and entire industries are being reshaped from within. But this progress comes with a cost, because the demand for computing power is growing rapidly, and that requires infrastructure, data centers, energy, networks, all of which are now becoming critical components of the global economy. So when you put all of this together, you start to see a much clearer picture. The world is not just recovering, it is reorganizing, balancing between high levels of debt and the need for innovation, between stability and transformation, between the old system and what comes next. And in this kind of environment, the biggest opportunities are not always the most obvious ones. They're often hidden in the transition itself.
And that transition is where the real story begins to unfold. Because when systems change, the effects are not immediate. They build over time, quietly at first, then all at once. What we are seeing now is the early stage of that process, a period where signals are forming, but not everyone is paying attention. And one of the clearest signals is the convergence between traditional finance and digital systems. This is no longer theoretical, it is happening in real time. Regulators are providing clearer guidelines, institutions are allocating capital, and technology is becoming more mature, all at the same time. This alignment is rare, and when it happens, it tends to reshape entire industries. But there is still hesitation, because change at this scale always comes with uncertainty. Questions about regulation, concerns about risk, debates about long-term viability. And that's why adoption is happening in phases, step by step, layer by layer, not as a sudden revolution, but as a gradual integration. And within this integration, certain themes are becoming more important: efficiency, speed, liquidity, interoperability, the ability for systems to connect and communicate seamlessly. These are no longer optional features, they are requirements for the next generation of finance. Because the current system, while functional, is not optimized for a digital world. It was built for a different era, an era where transactions were slower, data was less accessible, and global connectivity was limited. But that is no longer the case. Today, information moves instantly. Markets operate 24 hours a day, and expectations have changed. People expect faster services, lower costs, greater transparency. And the systems that fail to deliver these things will eventually be replaced. Not overnight, but inevitably. At the same time, macroeconomic pressures continue to shape the environment. Global debt remains high. Governments are managing complex fiscal situations, and monetary policy, while easing, still needs to remain cautious. This creates a delicate balance: support growth without losing control, encourage innovation without increasing systemic risk. And this balance is not easy to maintain, but it is necessary, because the alternative would be instability. And instability is something the global economy cannot afford at this stage. So instead, we move forward carefully, adjusting where needed, adapting where possible, and building new systems alongside existing ones until eventually the new becomes the standard and the old becomes obsolete. But this process takes time, and during that time, markets will continue to react, sometimes rationally, sometimes emotionally. Prices will move, narratives will shift, and attention will flow from one opportunity to another. But underneath all of that, the structural changes will continue, quietly, consistently, and for those who are paying attention, this is where the real advantage lies. Not just in chasing short-term movements, but in understanding long-term direction. Because direction determines positioning, and positioning determines outcomes. So the question is not just where the market is today, but where it is going. What problems are being solved? What systems are being built? And who is leading that transformation? Because in a world that is redefining its financial foundation, the winners are not always the loudest. They are the ones aligned with the future. And as we move further into this new phase, the gap between perception and reality may continue to widen. What people see on the surface and what is actually happening underneath may not always match, and that creates both risk and opportunity. Risk for those who rely only on headlines, opportunity for those who look deeper. Because sometimes the most important shifts are the ones that happen quietly before they become impossible to ignore. And by the time everyone sees them clearly, the advantage has already moved on. Which is why understanding this moment matters, not just as an observer, but as a participant. Because this is not just about markets, it's about transformation. A transformation that is already in motion, and one that will continue to shape the global economy for years to come.